Okay. I told you I was going to talk to you a little bit about health insurance and early retirement. And this is a funny thing because it's a common question I see on the forum, the Facebook group, the Reddit, in my email box. It's like, oh, what should I do for health insurance between the time I retire early and age 65 when I become eligible for Medicare? You buy it, right? This cracks me up because there are so many people in America who have never bought health insurance. Yeah, you can buy it just like you buy car insurance, like you buy life insurance, just like you buy groceries, just like you pay rent. You can go out and buy health insurance. There's nothing special about health insurance, right? Other than our convoluted system where so often it's purchased, in conjunction with your employer. A typical employer plan like the one we have here at the White Coat Investors, the employer pays 80% and the employees pay 20%. But what happens is people assume that health insurance only costs 20% of what health insurance actually costs. Health insurance is expensive stuff. The first thing you will do if you go out to buy health insurance on the open market, if you call up a health insurance broker in your area, and you can just Google health insurance broker in your town and find a bunch of them, is that it's expensive stuff. It might cost you if you got a family like these folks on the podcast, you're a married couple with a family of four. You're doing pretty good if you can get health insurance for $1,200 a month. It wouldn't be terribly unusual for you to be paying twice that. Health insurance is expensive stuff. And the reason why is because we use it, number one. Number two, healthcare is really expensive. And number three, there's all kinds of inefficiencies built into our stupid healthcare system. All this fighting back and forth between hospitals and docs and insurance companies and pre-authorizations and all this stupid stuff that's built into the system. You add it all together and it's just really expensive. Yeah, that's what you do. You buy health insurance. Now, what a lot of people can do if they're really into this fire thing is they are living on what kind of income during those years in their 50s or early 60s? Well, they're often living off some pretty tax preferred income, things like qualified dividends, things like long-term capital gains, or better yet, just the principal. If you sell high basis shares of your mutual funds, you might only be paying gains on 10% of it or so. And so you can end up having a pretty low, actual taxable income. And what that allows you to do is to qualify for the subsidies inherent in the Affordable Care Act. You can actually spend a lot of money and still get a big fat ACA subsidy because it's all based on, your income, your actual taxable income, not how much you're spending. So if you're spending a bunch of principal or money from your savings or whatever, you may not actually have much taxable income. You may get a big, huge ACA subsidy on buying health insurance through the exchange. So if you're in that sort of a situation where your income's really, less than six figures, you will get an ACA subsidy. So consider buying it through the ACA marketplace. But in general, when you have all kinds of choices for health insurance, you just got to decide which end of the spectrum you're on. Some people know they have health problems. They're on expensive, rheumatologic medications or neurologic medications or whatever. They know they're going to hit their out-of-pocket max every year. So these are the people that go for maybe a little bit higher premiums, but they have lower co-pays. They have lower co-insurance. They have a better panel of docs and hospitals to choose from. Whereas people who are in a really healthy family where they hardly spend anything on healthcare, they're looking for the low premiums, high deductibles, high insurance, high copays, or high co-insurance, high copays. Maybe not that big of a panel, but they're less likely to use their health insurance. It's more of a catastrophic coverage kind of thing. So you can get, a lower premium plan. Those lower premium plans are also often HSA eligible, and so that's pretty awesome if you can put some money away and then pay for those copays and co-insurance and those sorts of things using pre-tax dollars. So if the right plan for you is a high deductible health plan, be sure to use the HSA that comes along with it. But anyway, the main thing is when you go to buy this stuff, you're going to get sticker shock. It's super expensive, right? You thought disability insurance was expensive. Wait till you're actually paying full freight for health insurance. But if you can't afford to pay for your health care, for your health insurance as an early retiree, Newsflash, you can't afford to retire early. Keep working until you have a bigger nest egg or until you get closer to where Medicare will at least help out. But don't forget that it's not like Medicare is free, right? Medicare is not free. People think their health costs end at 65, not even close. Um, Despite the fact that 2.9 to 3.8% of all the earned income you ever made, which for a high earner is a lot of income, has been taken from you by the government to pay for Medicare. You have to be eligible for Medicare, right? So that means you have to be 65 plus, have worked for at least 40 quarters, be a U.S. citizen or permanent resident for at least 5 years, or be disabled. Okay, so most of you qualify for that. But that's Medicare Part A, right? Medicare Part A just covers hospitalization. It doesn't cover doctor visits. It doesn't cover medications. Doctor visits are Part B, and you have to pay for that. And Part D, it covers prescriptions, and you have to pay for that. So there's also, all this other stuff, Medicare Part C and Med Advantage plans and all that sort of stuff if you want it. But my point is, it's not like it's totally free when you turn 65. You're going to have to pay something still. So, what are your options really for those early retirement years? Well, the first one is you just roll the dice. I don't recommend this, but you could go bare. About 17% of my patients have chosen this option and do not have health insurance, despite the fact that many times the government would pay for almost all of it through the ACA, or if they would, just apply for Medicaid. But that's one option, is you can go bare. Another one is to just go to a broker and buy health insurance. I've done this myself for a number of years. I know what it costs. It's expensive. If you're self-employed, you can deduct it. But it's expensive stuff. Another thing you can do is you can keep the health coverage you had from your employer. You just COBRA it, meaning you take over the premiums that your employer was paying. You might have only been paying 20% before. Now you're paying 100%. You can keep that plan. If it's a particularly great plan or you really like it or you just don't want the hassle of changing, you could do that. You could COBRA your employer's health insurance. I mentioned the ACA. Go check it out, right? Run the numbers. See what your subsidy would be. It's probably significant if you have less than $100,000 in earned income. I think it actually, you can get something up to $120,000 or $130,000. I think these days it's probably family size dependent. But run the numbers and see what you actually get. Another thing you could do is you could get a job. Yeah, lots of people do that in early retirement. It turns out that they didn't want to retire to nothing after all. They didn't just want to spend all their time golfing, so they get an encore job. Maybe it's being a rafting guide. Who knows what it is, but that job might come with health insurance. You might also consider a health sharing organization. These are often Christian-based ministries. And the equivalent of premiums, I believe they usually call them shares, can be half the price. So it can be dramatically cheaper than health insurance. What you need to remember is that it's not health insurance. There are a number of things that they do not cover that you might think are covered because they're often covered by health insurance. So you need to really read what's excluded, what is not, and make sure you're okay with that. But these programs do tend to self-select a healthier population. And if you come down with something that requires expensive neurologic or rheumatologic or oncologic medications, you can always, in the next open enrollment period, just go back into regular health insurance because there's no exclusions now for pre-existing conditions. A couple of other options. The Trump administration passed a law, and I believe it's still in effect, that allows you to just buy a bare bones health insurance plan for up to 1 year. That sort of a plan can exclude medications and maternity and mental health expenses and have high deductibles and have a really low premium. It's only for 1 year, so it's a little bit like COBRAing your insurance. It's usually only done short term, but it might be an option for you. It's a little bit like health insurance used to be, that plan, but can be a lot less expensive. You can also do medical tourism, for stuff that's a little bit elective. It's just cheaper in Thailand. It's cheaper in Mexico. Now, you might argue there's reasons for that, but it is an option to help reduce the cost of some things. But, health insurance is expensive. It tends to inflate at a rate faster than the general rate of inflation for various reasons. But, this is not something that's going to keep you from retiring early if you otherwise have enough money to retire early. Yes, it's a big expense, but there are lots of other big expenses you paid for in your life, like, your housing, your groceries and stuff. What you need to realize though is the cost of medical care is much more similar to the cost of your food than it is to the cost of your cell phone. So it's expensive stuff. Expect to pay something for it.
The hosts of The White Coat Investor are not licensed accountants, attorneys, or financial advisors. This podcast is for your entertainment and information only. It should not be considered professional or personalized financial advice. You should consult the appropriate professional for specific advice relating to your situation.